Let's start the conversation with a broader based look at just what's happening around the news and energy. And Jan, for that, I will turn to you. Just how important have these recent headlines involving both Venezuela and Iran been to what has been the investing landscape for energy and energy stocks going into 2026?
Well, we're in Trump administration 2.0, and the president has said, I want more production, which is lower prices, or at least not rising prices. So energy companies have this big headwind. And I think in general, if you look at Venezuela, I don't think it's the biggest macro event in the world. So we at Van Eck have divided the energy world into miners, refiners, explorers, like nuclear, right? All different components. But I think the core old energy world is just a sideways world right now. It's hard to see. There's a lot of supply out there. There's supply of gas too, so I'd say not that exciting.
So when you say old energy, that implies there's also a new energy. So when you take a look at the way that the ETF world, the investing world has shaken out, just how much more attention is there now to old energy, hydrocarbons, oil and gas, versus some of the new energy themes we've centered around AI? And Jan, I think you have an interesting take on this.
Yeah, I mean, look, I think these companies need to lean into electricity, which is different than energy. And that's where the demand is coming from. The hyperscalers, the AI trade, we call it AI 2.0 trade. The ETF that we offer that's benefited the most is nuclear. A ton of performance last year, a lot of inflows. And even over the last couple of days, there's constantly announcements because there's two components to electricity. I call it the QR code. One is quantity. Well, we get, okay, we need more electricity. But the other is reliability. I don't think that R word is really understood well enough. Data centers can't be down. They can't take an hour off. They need the highest level of industrial reliability that exists. That's actually true for some other customers like the military and things like that, right? You don't want to have an airspace go down for an hour. So reliability is something that's also benefiting nuclear.
Now, Jennifer, the curious part about the energy trade right now is just how much, to the question I just asked Jan, is the emphasis on what is the traditional older gas players and oil players, if you will, versus what the kind of power need and the energy need will look like in the coming years and decades. Just how much are investors in a transition phase in your mind right now with regard to kind of making some of the differentiations between the two, and how is that investing landscape evolving towards a certain type of company or a certain type of investing that we haven't seen over the course of the last few decades?
Yeah, I think the energy transition is going to happen over a very, very long time frame. And as Jan just said, from a power transition perspective, that's almost how we think about it as TCW. That's essential. And that's where a lot of the activity is coming from. And so we think that we need all energy sources in order to feed the beast in terms of the demand for electricity, power for data centers, power for manufacturing and driving the growth in this America's block from a geopolitical perspective. We think that we need all sources of power. At TCW, we invest, we're an active investor. We think this is a market where you want to be selective and you want active investors. And thematically, we manage an ETF. The ticker is powered. And what we do in that fund is we're very broad. So we are holding some old economy companies, but a lot of what we're investing in is nuclear, both larger scale nuclear, sources of nuclear energy, and then companies that help us with efficiency of power. So for example, if you think about nuclear, we saw the announcement from Meta with one of our portfolio companies, Vistra. Meta is contracting within the next 10 years to add as much power as New York City uses now. I mean, think about the enormity and the scale of that. And so nuclear companies like Vistra are an important part of how, as Jan said, we get that regular power without the intermittency gaps that we have on some of the newer technologies.
Jennifer, just how much has TCW, the funds that you have they seen some of this kind of interest and I guess flow into these particular themes? Do you feel as though this is a ramp-up kind of strategy for you guys that has legs? And if so, what is the primary reason for driving some of that investor interest? And beyond that, How much more do investors have to learn about this energy transition in order to see some of those themes really take off in the coming years?
Yeah, I mean, when we look at the average portfolio, people have index funds. They're relatively well covered on the biggest tech names. But when you think of the scale of all of the companies that have to provide infrastructure and software and new sources of power, either on the AI space, we also run an ETF AIFD, which is the oldest broad investment in AI portfolio in the market in the form of an ETF. And then with a fund like Powered, we're investing in a way that's very broad so that as time moves forward, these themes are going to change. The winners and losers are going to change a little bit. And so our approach as TCW is we're managing the strategy for you in a very broad way. You can invest with us, and our portfolio managers will move the portfolio around as opportunities emerge. And as we go through what we think is going to be very exciting, but there will be some volatility in how we invest in both AI and sources of power and electricity in the next couple of years.
Jan, there is a case to be made right now that you could gain some of this exposure just towards traditional, maybe index-based ETFs and funds, ones that just track the overall industry, ones that you can just get some exposure to. There's another case to be made that you want active management, a portfolio manager, a research team that kind of goes through and evaluates some of the pros and cons and makes a fundamental decision about these types of companies. Just what role do active ETFs and passive index tracking type instruments play with regard to kind of how you invest in this energy transition in the coming years?
Yeah, I think probably agree with Jennifer on a couple of different points, right? That this change is so dynamic that you want a mix of the old and the new. And so even some of our pure play ETFs like oil services, like how many companies in that portfolio are really leaning into this transition on the electricity side? Not many, right? So the ETFs that we like actually in the space are the actively managed ETFs. So we have one that has more of a crypto background. The ticker symbol is NODE, N-O-D-E, but half of that portfolio is now leaning into the electricity transition. About 30% is Bitcoin miners that are, kind of leaning into AI transformation and doing deals with the hyperscalers, and 20% are the power producers like a Vistra. But even Vistra, which is now a large cap, it became a mid cap and now it's a large cap, so that's in your S&P portfolio. What's interesting to me about it is, sure, it had a natural gas generation capability, but even in the last 2 years, it's leaned into nuclear. And so nuclear it's that R in reliability that I want to stress that their customers are looking for. Not that gas isn't reliable, but the old alternatives of solar and wind are really not suited to what hyperscalers are looking for.